Joining us this morning, Ashley Webster, Liz McDonald, Scott Shellady, Dr. Barton, and John Layfield. All right, back to these big names who are waving the caution flag. Bond King, Bill Gross, billionaire hedge fund guy Jeff Gundlach, even Goldman Sachs has joined in. John, to you first. They're saying, get out of stocks, get out of Dodge. What do you say?
I disagree. I'm not actively buying right now. We've had a little pullback, but we're still within about 1% of an all-time high. But you got to look at the comparisons around the world. 80% of government debt from Japan and Germany are negative interest rates, while 60% of S&P stocks yield higher than our own 10-year treasury. So the place to put money that's rewarded right now is the U.S. stock market. So that's why I think that liquidity is going to keep the market higher.
That's a very fair point to make, John. We are the game in town that provides some yield. How about you, DR? What do you say when all these big guys are saying, sell it all?
Well, I understand John's point, and I will say that it's tough to get out while we're still making new highs. I think we've got to respect that trend. However, I think we have to be very much on guard, and that people have to be ready to have a get-out point, an uncle point, because while all these big people are getting out, while all these names, Gundlach, Gross, all the names that we've heard, Soros, the central banks have been propping us up, and there's been nothing in terms of global financial goodness that would tell us to stay in.
Look, for our viewers who want to get out if the going gets rough, it's relatively easy to put a stop-loss order in, isn't it, these days?
No buzzer for you.
No,
that's an error. That's a good point because it's so practical, Stuart, because it's so practical. Really good point.
It is easy.
Yes.
I'm not going to use the jargon, so I don't want the buzzer, but it is easy.
I think it just
go
made
on the
history.
computer, open up your account and say, I want to sell it if it hits that.
Right.
I mean, is that so difficult?
No. Thank you for clarity there.
Thank you for clarity. Thank you for the buzzer, Liz.
That's history made.
I want to bring in Scott Shellady because I've got to ask him about this. The Bank of England today, they cut interest rates and they say they're going to be buying. This is the Bank of England is going to buy corporate bonds. Now, what do you make of that?
Well, that was the surprising part. I mean, they said that they were going to cut interest rates this month, and they did. But then they delivered some more quantitative easing, and on top of the quantitative easing, they've now got a bond purchase of corporate bonds. Stuart, you know, this isn't good. I mean, as you see the central banks, and two of them are already mentioned today with Japan and ECB, they go more negative and they cheapen their own currencies. It makes the U.S. dollar, by default, more expensive, which really is a synthetic rate rise. See? So when you get all these other central banks around the world doing the work for us, then it kind of pushes us off again. So if you continue to see this action, which I think we will, now tomorrow could change everything with a really good number, but if we continue to see the action that we saw from the Bank of England today, and they said they're going to do more, it's going to make it harder and harder again to raise interest rates here.
By the way, isn't it picking winners and losers? Which corporate bonds are they going to buy? Which companies, right? And so they're trying to fix the danger of Brexit in creating more dangers for the corporate bond market, for the markets in general.
Yeah, why should governments or central banks pick winners and losers? And that's exactly what they're going to do with corporate. No, go ahead, Scott, go.
Why should central banks decide the price of things just by floating a lot of money? I mean, they've been in this market now for I don't know how many years, distorting the real price of assets around the world. That's the big problem.
Yeah, but Scott, they're in a trap.
We can't normalize in an abnormal world.
They can't get out. How do they get out of this mess?
Well, they put themselves in it. They've got mom and pop buying stocks that they shouldn't buy now, and now they have to have an eye on the stock market, which they never had before. So they're in real trouble, but it's their own fault.
Would you agree with the following premise? If and when the central banks of the world pull back, stop printing money, start raising interest rates, these stock markets all over the place, including ours, go straight down. Scott, would you say that's going to happen?
I think it'll be a big catalyst for that, yes, because I think you're going to see credit spreads widen out, and it's going to be difficult that way, too. And I think we're starting to see some of these stock markets not react to some of these cheapenings or easings that we used to see. I mean, you could have said a year ago we would have been up 50 to 100, maybe 150 today, even though we do have a number tomorrow. But we're starting to see more muted reactions to it. It's getting close to that time.
DR, the things fall apart if the central banks fold in?
Let me see if I can put this in very simple terms. Gundlach, Gross, all these people are getting out early because they know if that happens, there will be fewer buyers. It's a liquidity trap would be the buzzer word, but it'll be fewer buyers, not enough people to absorb all that selling, and boom.
John Layfield, is that the scenario you see? If and when the central banks reverse course, all hell breaks loose on the markets. Would you say that?
Absolutely. I agree with DR and Scott. I think they both made great points. I think the Feds and the ECBs around the world are out of bullets right now, and they really don't know what to do. And once they start pulling that liquidity out, I think it's going to hurt these markets
Painting
significantly.
themselves into a corner, Stu.
They have.
You know, ultimately, yes, the markets fall. Wouldn't it be great to let the market dictate asset prices and so on? So ultimately, it would be a good thing, but it would be a lot of pain to get there.
You're so smart. All right.